Welcome. Thanks for tuning in. Glad everyone could join us, and I hope everyone really had a great day. We've got quite the range of clients on this call, some younger, some older, some newer to real estate, and some seasoned professionals. Times have indeed changed, and I'm not sure we'll see 2 to 3% rates again. But for now, with the Fed's attempt to stem inflation, which has sharply moved up the rate on traditional Fannie Mae type loans, we're in the 5 to 6% range. And in the grand scheme of things, that 5 to 6% interest rate is still quite good. My name is Patrick Prunty. As I mentioned, it's a pleasure to be here. I can remember my first investment property, which was purchased back in the early 2000s. And rates at that time were in the 6 to 7% range. So really not too bad today. Additionally, I can remember my parents talking about the 18 to 20% rates in the early 80s around the time I was born. Certainly not sure we'll see those again. Anyway, we're here tonight really to promote Marshall Reddick's private financing division and to open the door to you, the client, to a conversation with us, the private financier, on how we can help if and when the bank simply can't.
Great. Well, thank you so much, Patrick. Awesome to be here with you folks. My name is Aaron Byrne. I work with the private financing department here as an investment analyst, and it's my pleasure to be with you today and look forward to sharing with you more about our private financing products. For a bit of background on me before we get into it, I graduated top of my class from Vanguard University with a degree in business. From there, I joined Marshall Reddick as an intern back in 2019. And I received my introduction to real estate investing through brokerage, property management, and private lending, where I work today. As I mentioned already, my current role is an investment analyst, where I've originated over 300 mortgages in states across the country. And I serve as a main point of contact for our borrowers and assist them along the way with our funding process. I hope to have the privilege of working with some of you on this call at some point. So without further ado, let's go ahead and dive into the content for tonight. Now, for those of you who don't know, Marshall Reddick Real Estate lends money. I must admit, it always surprises me how many of our clients have not heard about our private lending arm of Marshall Reddick to this day. But I suppose it makes sense, as we have allowed the program to grow organically over the years and rely mainly on referrals or webinars like these to get the word out. Now, going over a decade strong and nearly 3,000 mortgages funded for our clients, I'm proud of what our team has accomplished and very excited for what the future holds. Now, who do we lend to? For us, that's an easy question to answer. We lend money to real estate investors. Our private lending department was born out of necessity many years ago. Back in 2010, following the 2008 financial crisis, we mostly offered at that time services to help people buy or sell investment real estate. But one day, a referral agent of ours approached us about lending him $25,000 on an unsecured promissory note to help him buy some foreclosure properties at the courthouse step. As we're all aware, there were many foreclosures following the 2008 crisis, which served as an opportunity for real estate investors to capitalize on undervalued assets. After some deliberation, the principals of Marshall Reddick at the time decided to supply the $25,000 requested. Just like that, the private financing department was born. So unheard of today for us to make an unsecured loan because we're always recording our lien against the collateral asset, but the story speaks to the true relationship-based foundation that our private lending department was built upon. Our company mission is to be the bridge that connects our clients to financial independence through real estate. And this arm of the business, this private financing arm, is one way that allows us to do that effectively. It's great to see our clients continue to build wealth through the real estate that they invest in, and we are so honored to be a valued resource for many of their investment activities. So, to get it out of the way, we are not a traditional lender. Now, that title does beg the question, what is a traditional lender? A good example would be big banks like Bank of America or Wells Fargo. The traditional lender generally has lower interest rates and will offer higher leverage, or also known as less borrower equity left in the property. They are able to offer such terms because they have access to both lower cost and more plentiful capital than the private sector historically. So whenever possible, we always recommend to go traditional. But that being said, the traditional lender is very rigid with many restrictive guidelines a borrower would need to clear before they are able to obtain financing. The reason stems from the fact that traditional lenders do not retain ownership of their loans after closing. Rather, they sell them to government-sponsored enterprises like Fannie Mae or Freddie Mac. I'm sure most on the call have heard those terms before. Since they plan to sell the loans they originate to the GSEs post-closing, they must abide by Fannie Mae's strict underwriting criteria in order to ensure their loans get purchased. Those guidelines set by those government-sponsored enterprises may disqualify certain investors and leave them high and dry without any alternative for financing. If you fall into this category, then you're in luck. That is the niche we seek to serve. So I do want to pause and take a moment just to say hi to all the new people on the call. It's great to have you here. We really appreciate you spending time with us. But I also see many familiar names logged in who are longtime Marshall Reddick clients and will be familiar with my next point. Because if you know anything about Marshall Reddick, you know that we have helped many clients buy investment property during our rich 40+ year history. It always amazes me to think about how we have helped clients buy thousands upon thousands of investment properties over the years, from single family residences, small multifamily like duplexes or fourplexes, and beyond. This fact has granted us unparalleled experience and knowledge of the residential real estate industry, and we meet the needs of our clients in various markets and different market conditions. What we have observed through that history and helping our clients buy and sell these properties is that many of our clients are purchasing property in non-traditional ways. There are as many investment strategies as can be imagined and executed by our clients. So while many of those methods may work in a traditional sense, some others require a bit of greater customization in order to effectively achieve the desired results. The traditional lenders do not cover everything, and this leaves our clients operating in a dead zone of coverage, so to speak, with the missing puzzle piece to their strategy being the financing arm. When investors ran into this problem in the past, the only viable alternative was to bring all your own cash to close the deal. But this is no longer the case, as many of us are aware. The market has recognized the need for more flexible financing solutions for real estate investors. And we at Marshall Reddick are striving to accommodate as many investment strategies for our clients as possible. As we are all aware, and as Patrick alluded to in the introduction, times have changed for real estate investors. We're coming out of a period of hyper appreciation, and the insatiable demand from home buyers over the past 24 months was an entirely different outcome from what we anticipated upon news of the global shutdown during the pandemic. Nevertheless, all good things must come to an end at some point, as the saying goes. With the recent economic data being published, 3% rates are a thing of the past, as the Fed has increased their overnight funds rate in an effort to help curb inflation, as Patrick mentioned. If you look up the average cost of capital today for an investment property, we would all find that 5 to 6% is very commonplace. We're all adjusting to the initial sticker shock, and the media has made real estate investment more popular now than ever. Sites like BiggerPockets allow investors to share ideas and strategies with one another around the globe in real time. This has led to the rise of investment strategies like the BRRRR method, among others. Popular media, paired with advancements in technology, makes real estate investment more accessible than ever before. But due to the rise in rates by the Fed, traditional lenders have needed to raise their rates alongside the Fed. This has pushed some of the buyers out of the market. It's also closed the gap between rates between the traditional and private sectors. This has made private financing more attractive than ever. And we will show you some examples later in the presentation about how that might add value for your investment activities.
Yeah, Aaron, awesome, thank you. And it's really amazing how the sharp increase in the rate has brought the traditional sector so close with the private sector. And there's so much private capital out there today that's starving for yield, that's keeping that private money cost down, right? And it's like we're realizing that a 5 or a 6 or a 7, single digit interest rates are actually really fabulous returns, especially when you have real estate as collateral and first lien position like we do. So I think that everyone's going to be shocked as we move along in this presentation to really quantify how close traditional versus private is today, a lot due to technology, as you mentioned. And this is just a space that Marshall Reddick can play in to help its unique clients, right? They can continue their real estate goals and march towards that financial independence. But we do love crowd participation. We've prepared a few polls and we'd love to get some feedback from the crowd. Let's go ahead and get those launched. Start with our first. All right, so you should see it now on the screen. What do you think about mortgage rates? And what do you think, Aaron?
Certainly been a heavily debated topic as of late. It's the back-to-back increases by the Fed I remember seeing was the highest raise in rates since the 80s, I believe.
Yeah, no, interesting. In the grand scheme of things, as I mentioned, though, it's like the 5% that we're at today, I think is a very healthy rate. I think that it's not only gonna, kind of try to bring down inflation, but it's like we're getting back to a normal operating market. You know what I mean? It's not 25 offers on every property and just this feeding frenzy constant. So I think it's actually a good thing to get us back to some state of normalcy.
I agree. I do think that I'm not sure if we've hit our ceiling yet, but we're getting there. Yeah. And we've kind of seen that in the mortgage markets kind of stabilizing a bit in recent times.
Yeah. Okay, we've got good crowd participation there. Thanks so much. We're going to go ahead and close the poll, and then we're going to share the results. And I'm a little shocked. I expected to see some folks more grim and expecting double-digit rates coming soon. So I'm glad that nobody's feeling that way. Not sure what the Fed thinks, but I think 5% is the new norm for me. I don't think that we're going to see too much of an increase over the next, 6 to 24 months. Thanks for the participation, everybody. Well, we're going to launch another one and keep that crowd participation going. So we'll hide this one and move on to our second poll question. All right, so we've got it launched. What kind of borrower uses private financing? And this is always an interesting one. I think people might have a negative connotation when it comes to private financing from time to time, and not really understand the type of client that benefits the most from these unique financing solutions that groups like Marshall Reddick offer. What do you think?
Yeah, I would totally agree. And I think that there's been a wave of changes as well in the private financing sector. It's really come a long way. A lot of bigger players have kind of come to the space, as you mentioned, with larger stores of capital, starving for yield. And so it's really had an impact on kind of standardizing and kind of bringing normalcy to the private sector that really has just opened the doors for so many more investors and so many different strategies to actually effectively accomplish those goals.
Absolutely. Okay, we're gonna move on. We got a lot of good content, so we're gonna go ahead and close the poll. Right, we will share the results. And again, a little shocked as I talked about that negative connotation. A lot of times, folks think that private financing is for the subprime, perhaps with poor credit, or even sometimes first-time borrowers. And it's actually the opposite of that. Right, and we do have a bunch of people talking and voting for limited cash available for down payment or reserves, and that's absolutely incorrect as well. the number one reason that folks at least approaching Marshall Reddick and utilizing our private financing are sophisticated real estate investors. Right, and I'll give you just a quick example because we're going to go over that. One example would be folks utilizing their retirement accounts and in need of a non-recourse loan to purchase and own real estate. And Fannie Mae and traditional type lenders require personal guarantees and do not make non-recourse loans. And so we have folks like that utilizing our private financing. And that's just one of the use cases. I know you're going to go over several. So let's get back to it. But thanks again, everybody, for that participation. It's really helpful.
Absolutely. And as Patrick mentioned, we do thank you. It's always great to hear from the crowd and kind of get the sentiments of what you guys are thinking about the market and where we're headed. So before going further, like Patrick said, we do have a couple examples that we are going to go into about actual clients of ours who use private money. I wanted to take the next several slides to talk more about our private lending model. So you have a better idea of what box or what scenario may be a good fit for our services in the event that you're looking to use private financing at some point. So on our side, the question is, what borrower cannot go traditional? I mentioned that, in the last poll, the main client who uses private financing is a sophisticated real estate investor. But who is that sophisticated real estate investor? They take on many shapes and forms. So we wanted to give you some examples of when to look for private financing solutions. A good example would be a self-employed individual, like a business owner, real estate agent, or maybe a retired person, someone who is well capitalized, but simply cannot meet the income requirements levied by Fannie Mae because they're on fixed income. Another scenario is when a borrower locks in an amazing deal, but has a very tight window to close on the property. And they are very motivated to find some way to close and not lose out to a cash offer because of the absolutely amazing upside for that property. Another one would be if the borrower needs a non-recourse loan. The law mandates that if you need a non-recourse financing, you must use it for your self-directed retirement account, like Patrick mentioned earlier. And so a traditional lender simply does not accommodate for that. We, however, in private financing does. Another one is if you already have 10 financed properties with conventional loans. There's a Fannie Mae guideline that limits investors from getting more than 10 conventional mortgages, even if the properties themselves are cash flowing, or if the borrower himself has the income and the debt to income requirements necessary. And finally, the borrower who wants to buy a property in the name of an LLC or corporation, using it for asset protection purposes. But as mentioned, same with like a non-recourse loan, a traditional lender wants to lend to you individually with that personal guarantee. And so they would not be open to lending to an LLC or corporation if that is your investment model.
Yeah, absolutely. And I want to just touch on 2 points here. The non-recourse loan is a big deal. Lots of folks today tapping into those retirement accounts. I am one of those. I have 2 self-directed retirement accounts, and I have purchased and owned rental property inside of them. I've borrowed a number of non-recourse loans. I know that there are only a few players in the country that make those types of loans, and we're very competitive when compared to those other non-traditional type lenders that would consider making such loans. Additionally, I know we've got a case study coming up later about the LLC situation and some real live situations that have to do with the 1031 exchange, where we've gotten some clients out of some really tight binds when they were facing major tax liability with a failed 1031 exchange where the relinquished property was held in an LLC before it closed. So thanks for these examples.
Oh, absolutely. And there's plenty of more scenarios where private financing is the only option available to borrowers, but these are 5 of some of the most common. So we wanted to give these to you just to help give you some context as to when private financing becomes invaluable to the real estate investor. So essentially, we're now going to talk a little bit about Marshall Reddick and our approach to private financing, because there are many. For us, when it all boils down to it, we care a lot about the property. Our main focus is not on the borrower when evaluating a deal for funding. For example, credit is not important. We do not verify income or employment. We do not ask for a schedule of real estate or require tax returns and the corresponding documentation. All these items are qualifying the underlying borrower, like a conventional or traditional lender does. In our opinion, though, these items are irrelevant to our no-doc approach to lending. Now, that last point does beg the question, what is relevant to us? We still strive to make smart, common sense loans, and we're not in the business of making bad loans on bad projects. To avoid that outcome, we are concerned with borrower cash available for down payment plus reserves. When it all boils down to it, does a borrower have the cash to complete the project? And does he have enough reserves to weather when that unforeseen situation arises? Because experience has taught us, usually will. We're concerned about the collateral property value and the borrower's equity. Does the property value justify the loan amount being requested? And does the borrower have enough skin in the game, proving to us that they believe in the deal and are vested in executing their plans for the property? We're also concerned about the collateral property's cash flow or debt service coverage ratio, DSCR if you will, on screen. Does the property, after paying all monthly expenses, stand on its own? And finally, borrower background and experience. After being in a business for over a decade, funding thousands of loans, we've understood that having a borrower who knows what they're doing and has done it before is a major consideration and directly affects the success of the project. While everyone does have to start somewhere, and we're more than happy to help with that, we do take this element into account during underwriting.
And just want to touch quickly before you move on, when it comes to DSCR, debt service coverage ratio, that's a fancy term, but ultimately, we're going to have a down payment requirement that forces the borrower into a very positive cash flow position. In essence, the property must stand on its own to support the debt service. We wouldn't allow a situation where you are running a negative cash flow.
Absolutely. Just going into more of some of Marshall Reddick's guidelines here. We lend on non-owner occupied property only, or essentially investment property. This is for us to operate under and within the guidelines set forth by Regulation X and TILA, or the Truth in Lending Act. All of our loans are eligible for purchases, a refinance, or cash out. You could be acquiring a new asset, you want to replace an existing debt, or maybe the property is appreciated and you want to pull out equity. They are all covered in our programs. We lend in first lien position only. We don't make HELOC loans. Since we are a collateral-based lender, as I discussed in the previous slides, we lend only in first lien position, because when it comes time for you to sell the property, or for our borrowers, God forbid, if they default on the loan, we would be first in line to get paid off. We do not lend in junior position or permit our borrowers to take out juniors on the property during the term of our loans. A popular example of a junior loan is a HELOC. So that would be a great example of what kind of junior loans we do not make.
And it's really important to just make a quick note there as well, Aaron. We get approached a lot of times about people who have investment property that maybe needs work, or maybe they're considering building an ADU or something of the sort, but they're sitting on a first that's a 2 or 3% or 4% interest rate, a very favorable 30-year fixed. Right? That is not a situation where we'd be able to help, because you'd be looking not to refinance out that first and put us into first in order to get the cash to build the ADU or whatnot. And we're not going to lend in that junior position behind your existing debt. Right? So just wanted to make sure that everyone was clear further that it's first lien only, and to know exactly what a junior or a second would be, which is what a HELOC or a home equity line of credit is.
Absolutely. And thanks for that detail, Patrick. Hopefully that helped clarify. But please, if you have any questions, we will be dedicating some time towards the end of the webinar, and also happy to follow up as well after the webinar and help answer those questions for you, whatever they may be. So the final point on this slide would be that all of our loans, as you can see on screen, they're non-recourse eligible. Be advised, however, We only make those non-recourse loans when required by law, which is required when making a loan to like a self-directed IRA or a solo 401k trust, etc. On screen now, you'll see a graphic taken from our website, and it's showing what states we lend in frequently. That said, we're always open to a good deal. So if you don't see your state listed, please give us a call, run the deal by us. You never know what we might be able to put together. Again, one of our advantages when compared to a traditional lender is that we permit for a vast array of entity types to borrow using our programs. Some of those approved entities for us are individuals, of course, LLCs or limited liability companies, corporations, whether that be a C Corp or an S Corp, revocable or living trusts, self-directed individual retirement accounts. These are typically facilitated through a custodian. Self-directed individual retirement account LLCs. These are great for borrowers as it gives them checkbook control. And as mentioned previously, solo 401k trusts as well. If you have another entity in mind, again, please run it by us and we'll see how we can help. These, however, are entities that we run into very commonly, and we feel that they capture the wide array of investment borrower entities that are available and that are being used on a regular basis. Now, it is important to note that we are a residential lender. Reddick is a residential real estate company. It has been our bread and butter for many, many years. But we would like to help our clients as much as possible with all their real estate investment activities. There are simply some asset classes that are just outside of our wheelhouse. For examples of some properties that we will lend against, we have our single family residences. That is our preferred asset class. We will lend against small multifamily, 2 to 4 units, so like a duplex, a triplex, a fourplex, absolutely. We will also lend on 5+ unit buildings up to 20. And finally, we will lend on raw land. I just want to put a quick note here though about the 5+ units and the raw land. We will definitely make those loans, but be advised, it's not our preferred asset class. Again, we are a collateral-based lender. So the property or the asset is most important when considering making the loan. Not to say that that's a hard stop by any means. If those are the assets you're looking for financing on, please send them our way. Just be advised that it may be subject to reduced LTV based on our standard guidelines.
And just to clarify that too, right? 5+ multifamily or raw land, no problem. And when Aaron says increased LTVs, that means, decreased LTVs, that means increased down payments, right? So as you're going to find, we're very comfortable with 70% loan to value, especially for new purchases, right? But when it comes to a 5+ apartment building or raw land, we're going to drive down that loan to value and drive up your down payment. So again, where we're comfortable with 30% down on most assets in the residential space, we're going to require more than 30 down when you get to these 5+ or the raw land.
Absolutely. Thank you for clarifying, Patrick. Again, any questions you have about that, we're more than happy to chat with you. Please give us a call, shoot us an email. Love to discuss further. Now, just to give some examples of some property types and classes we do not lend against. We do not lend on industrial or retail, medical, or like an office or mixed use building. Essentially, if it has some sort of commercial application, we are going to steer clear of that asset type. Now that we all have a bit more context about what a traditional lender is, we kind of talked about who those lenders are, what they do, and a little bit more to what scenarios might be a good option for private financing and how we, as Reddick, approach a private loan. I now want to talk through a hypothetical situation and give you some real numbers to help illustrate how we compare to a traditional lender. As you can see on screen, we have a beautiful single-family home that's for sale. The house reminded me of investment homes that our clients purchase out in Florida, so I thought this would be a perfect scenario for this example. To start, we are going to need to make some assumptions. First, we're going to assume that the home's price is roughly $300,000. Florida has been exploding in popularity and appreciation recently, but for the sake of argument here and for the example, we're going to set the value there. Next, we're going to assume that the traditional lender is going to require 25% down on the investment home, and that our private financing program is going to require 30% down.
Which for a single family home is exactly correct. And the traditional side, you can get some that will do 20% down, subject to higher interest rate, but really the standard Marshall Reddick client going the traditional routes, putting down 25%. And so literally 5% more if for some reason you need to go private.
Absolutely. And just as a reminder for that 5%, we're collateral based, and we actually portfolio or hold our loans to maturity. Thus, unlike the traditional lender who was going to sell that loan to Fannie Mae or Freddie Mac in the secondary market, we are going to hold the loan through all the ups and downs of whatever the real estate market does. So that's why for us, that down payment, that extra 5% is important. For the interest rate, we are setting the traditional lender's figure at 5.5%. This figure is accurate according to the mortgage report as of yesterday, August 22nd, for a 30-year investment loan. I looked again today while I was actually coming in here, Patrick, and I noticed that it did actually tick up about 15 basis points. So this 5.5% rate today is a conservative number. As comparison, we are going to use our rental program here at Marshall Reddick, which is at a 6.5% interest rate. And it's only a percentage point difference between the two. And while traditional lenders are going to change their rates, we actually have decided to hold firm to the 6.5% interest rate through the end of 2022. Finally, we're going to assume that both loans are on 30-year terms. One being fixed, and that's going to be the traditional option. The other is going to be adjustable with a 3-year fixed period, shifting to adjusted after that. Now that we have our assumptions, we're going to take a look at the traditional lender's numbers first. To build this comparison, I use the Marshall Reddick financial calculator to plug in the numbers for this slide. It's a free resource at the URL shown below on screen. If you have any interest or would like to run your own numbers, please visit that URL. It's a great resource to use. Using the metrics in the calculator, it assumes 3% closing costs for purchases near $300,000. When running the numbers down on the screen, you'll see that we arrive at approximately $84,000 cash to close and approximately a $1,300 monthly payment to cover principal and interest. Switching now to our private example, the Marshall Reddick calculator assumes 4.2% in closing costs for private purchases near $300,000. And when running the numbers, we receive an estimate of approximately $103,000 cash to close and a $1,300 monthly payment for principal and interest. In summary, there's a lot of variations, of course, but this example was just going to highlight the basics between the two lender types. The difference is only about $18,600 more to close, the vast majority of that being equity on the property, and about $50 more per month in your monthly payment to service the principal and interest. The big takeaway is that private financing is a viable alternative. If for some reason that you can't go traditional, we offer a really competitive solution for investors who are seeking to still buy that property.
Yeah, it's really shocking when you put them side by side to see just how competitive it is. I know we've talked about that a little bit along the way. And I think we're just really spoiled previously with 2% and 3% and those interest rates. And we're getting back to that normal market, right? And just the amount of private capital sitting on the sidelines that would love to be at a 70 loan to value position for a 6.5% rate. It's out there, right? And so this bodes really well for our Marshall Reddick clients looking to continue to stack assets and to build wealth. So at the end of the day, $50 a month payment, certainly would I like to have $50 more a month in my pocket, but if there's a scenario where I can't go traditional and I need to go private, you have a resource to be able to do that.
Absolutely. And thanks to everyone, by the way, for staying with us up to this point. We're past the halfway point. Take a breath. Everyone give us a thumbs up. We're going to go ahead and dive into the next section. Thanks so much for being here again. On that note, This next section is all about the borrower tab on the Marshall Reddick homepage. There's a picture on screen illustrating where that said tab is located. And we're going to take a brief second to kind of give you a guided summary of what you would find should you visit that tab and our website today. So first off, as mentioned, we serve real estate investors, and we offer a variety of financing solutions to fit virtually every scenario. So we make the following types of loans. We make renovation loans. You hear a lot of times the terms BRRRR method, where they buy the property and they renovate it before refinancing and renting it out. That's something that we accommodate. Fix and flip loans as well. A lot of the we buy houses for cash people have a relationship with a private money lender like Marshall Reddick to help them close on their deals and close on them quickly. We also make new construction loans. We do this for builders who are doing, smaller volumes. We don't work with the, 100 million plus kind of guys. We work with those folks who are doing, 25 homes or so a year, or maybe they're doing those custom builds. We also offer rental loans. We talked about the debt service coverage ratio. We talked about the cash flow and the long-term rentals. And this is for those folks who are wanting to expand their rental portfolio and continue to gradually increase their wealth through real estate investing. We also offer bridge loans. These are the dynamic solutions that help plug the gaps for our real estate investors and our borrower clients where needed. While all these programs are available for review on our website, and they all are excellent at serving their specific needs, for the purposes of this webinar, we're going to focus mainly on the final two types, which is going to be those rental and bridge loans. Should you navigate to the URL on screen in the borrower tab, you would be met with the following page. This is where you can find and review all the rates and terms of our loan products in one place. We really do strive to be straightforward and to operate as common sense lenders. So for full terms and details about each program, you can download a rate card in PDF version for review anytime from our website. As mentioned previously, we do not have time to go over all the programs, so I'm just going to dive into the rental and the bridge program rate card in the scope of this presentation.
I think it might be also important to note, while the traditional lender is literally changing rates and terms like by the day or maybe even by the hour, all the time, Marshall Reddick seldomly changes our private rates. We literally set our own private rates, our own loan to values. We're not selling any loans to Fannie Mae or anybody else that gives us these guidelines. We literally portfolio all of these loans so we can do anything we want to do. So when we say that we're not going to change those rates, like we're good collecting on this paper at these loan to values over the term.
And that just provides a wealth more of opportunity for borrowers to be able to take advantage of those programs and really be able to rest easy in terms of if you didn't rate lock the week before, or what's the mortgage market or the economic times going to do in the next few weeks here. It helps kind of give that ease in terms of knowing that we at Marshall Reddick are comfortable at those loan to values and terms, and we also seldomly change. So I thank you, Patrick. I think that's a great chime in. And so now just jumping back on the train of thought that we left off at, we're now going to go ahead and jump into that rental loans rate sheet that I had circled there on that last slide. And when you download it, you're going to be met with the following page. In light of the changing environment, we have opted to go with a single rental program. It is a 30-year option at a 6.5% initial interest rate. And while this is a 30-year loan and is fully amortized, as mentioned previously, be advised, it is an adjustable rate after the initial 3 years. Another important point to note here is look at the closing timeline. This is a benefit for our borrowers. Conventional loans taking as long as 45 or 60 days to close, because we take a no-doc approach, it streamlines the process for you as the borrower. We are much more efficient and we are much more enjoyable to work with. We're able to work in tighter timeframes and we're able to meet the dates and deadlines for our borrowers. While fees are a little higher than a traditional lender, ours are simple. They're straightforward. We don't have any hidden junk fees to worry about. So you don't need to worry about coming to us and getting quoted a fee, only to have us change it a few days before closing. Next, we're going to go ahead and jump into our bridge loans rate sheet. And moving on to these bridge programs, these are the ones to use when the need is for speed. You can see the 14 to 17 day close time there. And the rental program shown previously, that's great for the people who have more time, but they just can't go traditional because they can't get the loan fulfilled by a traditional lender. They need a private solution. For these loans, however, these are the ones you can use to fill the gaps, or if you need quick, effective solutions for your investments. And with the ability to waive an appraisal if you have the cash, it is the ultimate program if you just need to close quickly to make sure you don't lose the deal.
Yeah, and this has happened so many times recently. I mean, the mortgage market has been all over the place. And I mean, we've had clients approach that are buying new construction, okay, and they've been under contract for like 9 or 12 months. The property significantly appreciated over that time, and their lender that they've been talking to the whole time does some kind of bait and switch or can't close right in the 9th hour, and that builder is so happy to cancel your contract and sell that property to somebody else at the now prevailing cost. And instead, boom, you can come into Marshall Reddick, and with 50% or more down, we can waive your appraisal, and we're literally talking about closing in just days. I think we did one earlier this year in literally 3 days, right? Marshall Reddick client, new construction in the same situation I just described. So I tell you guys that again because I just want to let you know that there's no scenario off the table unless it's a junior lien. Okay, so if you come across a situation or you know somebody or you have a client, so we know we've got a lot of real estate professionals on the call, right? Feel free to send them over. We'd love to be of assistance.
Absolutely. And just kind of validating what you said, Patrick, I had the privilege of being the investment analyst on that loan, and I think we got the application on Tuesday and we closed by Friday.
Yeah, amazing.
So now moving on, we're going to stay in the borrower tab. I'm now going to show the page that you would go to if you were to apply for financing. Please note you will need a username and password to submit a loan application on our website. So just be prepared for that if you were to visit this page. Essentially, you would click the private financing option on the left there and follow the directions, entering the necessary information about you and about the deal and etc.
Note that this application is going to take you all of 15 to 20 minutes. This is nothing like a standard 1003 where they're going to be beating you up for every bit of personal financial information you could think about.
Absolutely. Again, we're a no-doc lender. So really, ease of transaction is a really big sell for us and something that we love bringing in and helping our clients achieve. So yes, absolutely. But at the same breath, if you do run into some snares or some hiccups, please feel free to email, call. I'm happy to jump in and help over the phone and get that application to the finish line. After you successfully submit your loan application, either way, myself or one of the other investment analysts on the team will give you a call. And we're going to go ahead and go over more specifics about your deal and see how we can help you accomplish your goals for the project. Now, as promised, we've been kind of leading up to this for a while, but we are going to go over a couple case studies. I'm a very visual learner, and I like to learn from hearing from other people's examples. So we're going to talk about a couple of real life loans that we helped our clients fund and originate, and just to demonstrate the power that private financing can have to solve the transactional problems in real estate investing, because there's many of them. So case study number one, here's the scenario. Looking at a new investment purchase. Client found the property, exactly what they were looking for, hit all their investment criteria, they got it under contract. The loan, they were going traditional, they got it approved. The lender said, you are clear, you're good to go. However, the lender had one caveat. The borrower didn't quite have enough cash reserves in the bank for their guidelines. Now, this borrower was well capitalized, owning multiple other real estate and other investments, but it just wasn't liquid in the bank. The investor came to us, and here was our solution. We utilized the bridge loan program. Again, mentioning if you have a project or a property that you want to close on quickly and you want to capitalize and not lose that great deal, bridge loan is the key. And essentially, as mentioned, this borrower is well capitalized. They owned another property free and clear. And so at maybe 25% LTV or whatever that fee ever came up to, we lent them $150,000 against that property, which they then were able to use as reserves for their new purchase. After they closed on the new purchase with those cash reserves, they were then able to simply pay off the bridge loan within the term as needed.
This is a really good case study, just so everyone's aware, right? There's a new purchase, they're getting a traditional loan, the lender just wants to see a little more cash reserves, right? The borrower came to us, they utilized a separate property, not the new purchase, a separate rental property that they happen to own free and clear. In a matter of days, we put in a very low loan to value bridge loan secured against that alternative property to give them the cash reserves that they needed in order to close on the new purchase. Subsequent to closing on the new purchase, right, they were then able to, if they wanted, pay off the bridge loan against the alternative collateral property and get back to basically the same situation they were in before.
Absolutely, and that's just, again, demonstrating the power that financial lending in the private space can give to our clients, being able to find a solution for a seemingly insurmountable problem. So next, we're going to look at one more case study. In this case study, here was a scenario. We had a client, they owned an existing rental, they've owned it for many years, and they want to take advantage of the market. They've been holding it for a while in an LLC. They quit claimed it to the LLC somewhere along the lines where they had purchased the property versus where now they're trying to sell it. And so they decided to take advantage, since it was an investment property, of the advantages of a tax-deferred 1031 exchange. However, during that process, and after selling the initial existing rental property, they realized that they must take title to the new purchase in the name of the LLC. This obviously caused a problem, as traditional lenders don't lend to LLCs. They want that personal guarantee. They want the max amount of recourse as possible. Now, this borrower is in a bind. The client of ours has a specific window they got to complete the 1031 exchange within, but their plan A lender is not able to help them anymore, as they have to buy the new property and take title to it in the name of this LLC. Thankfully, Marshall Reddick had a solution. So in this case, we went ahead and used one of the rental loan products that we have. In this case, it's that 30-year loan that we offer for rental loans. And on our side, as mentioned before, approved entities, LLCs, no problem. So we allow the LLC to make the new purchase, which satisfy the requirements of the 1031 exchange within the window needed.
Yeah, and this literally happens more than you would expect. And just to kind of dial it up, so you buy a rental property, let's say you've owned it for 10 years, right? And you got a traditional loan when you purchased it, it was titled in your personal name. And then somewhere along the line, you got this idea that it would be good to transition your properties into an LLC ownership. So you literally change the title to the property to the LLC. Then fast forward another 5 years, you've owned the property for 15, you've got it titled in the LLC, you enter into a sale agreement, right? You sell that property and you close on it, called the relinquished property, and it closed in the name of the LLC. Like, no problem doing that. But then it's like when you're going to complete the purchase or multiple purchases as a part of the 1031, the exchange accommodator is going to require you, per IRS guidelines, to close on the property in the same name. The new purchase property is in the same name as the relinquished property. And voila, you went, uh-oh, I didn't realize that, right? And now you're perfectly qualified for a traditional loan, but one caveat, the traditional lender will under no circumstances make that loan to an LLC. Right? That's when you're either looking at a failed 1031 exchange and potentially a very large tax liability, unless you don't have an alternate solution. In comes Marshall Reddick, right? We'd be glad to make at a little bit, not as favorable terms as a traditional lender, but we make loans to LLCs all the time, therefore allowing you to complete the 1031 exchange. And then at some point after that, go ahead and title it back to your name personally, and then go back to the traditional lender to get a better term or a better interest rate or whatever you want and pay off our rental loan subsequently.
And again, just another scenario, something that you don't think about till you're there, but when you're there, it's crunch time. You have to find that solution. And so it's amazing how we've been able to help our clients with these scenarios and many others over the years. And I know we have a lot of real estate investors on the call. So we have solutions for the above 2 case studies. And I would suspect that we have a lot of solutions for maybe scenarios you guys are going through as well. So please schedule a consultation. There's a URL on screen. I'll take you to the following page. Let's discuss and see if Marshall Reddick has a good solution for you. Otherwise, you're welcome to submit that formal consultation request, but feel free to call me. I have my number on the screen. I get calls and texts there, or I also have my email address. If you want to shoot me an email, maybe some more detail, attach some files to it, don't hesitate to reach out. Happy to see if I and the team may be of service to you.
Yeah, Aaron, thanks so much. But we're going to wind it up, but we do have several questions that we fielded from the crowd. We'd like to address those now. Question is regarding borrower, right? Foreign nationals or non-resident alien. And the answer is 100%. We have many foreign clients, right? Lots of Canadians, lots of Israelis, and so on. What you will need, however, is a U.S. tax identification number, which can be accomplished either with an ITIN, or you can apply for a U.S. entity, S or C corporation or limited liability or something, and use that entity and its associated U.S. tax identification number as the borrower. But yes, 100%, no problem, no change in the terms. LTVs, interest rates are all the same for foreign nationals or non-resident aliens. Additionally, another good question we have from the crowd was with regard to our construction financing, right? And it talks about if we lend on raw land, are we lending at the value of the land, or are we including the cost of permits and construction on it? So there's really 2 questions there. Number one, if we're lending on raw land, we're going to lend like a bank would at purchase or value, whichever is lower. And in that case, we're really not going to be comfortable at anything more than 50% loan to value. Okay, so if you need to take down the land and you don't have the cash to do it, you're looking at 50% less LTV. That's just the land. Now, if you're looking to build on that land, generally speaking, we are going to want the borrower to own the land free and clear, okay? Which means that when it comes time to permits and things of that nature, you're going to need to front the costs of those soft costs until you get to the point in time, and we're happy to set up the construction loan. You just can't draw on it until your permits are approved and you're ready to start breaking ground, right? So it's at that point in time that we're going to, in a reimbursement style fashion, just like a bank would, have you or your builder put down the slab before you can start drawing on it. And then you put the sticks up and the trusses and so on, and then you draw down on the loan. Okay, we're really looking at 2 different loans there. There's no such thing as a construction to perm loan with Marshall Reddick. You can have a loan against the land, which then will need to get paid off, or very down to a very low LTV, and then you can borrow the construction to go vertical before you can then refinance out with a traditional lender or Marshall Reddick with a longer term solution beyond the 12 to 18 to 24 months that we would allow for a new construction loan. I have another question, and then we're going to tie it up. We're approaching our 60 minutes. And the other question, I'm going to give this one to you, Aaron. It's revolving around pre-approval letters. In a very competitive market, we all know that we've got to make decisions quickly, right? And if you're going to be making a financed offer, you're going to need a pre-approval letter, a bank letter. Do we provide those to our clients or to the associated real estate agent that the client's working with in order to help the agent submit that pre-approval with the offer?
Absolutely, we do. Again, as Patrick mentioned, we recognize and understand the value that that pre-approval letter can give to an offer that our borrowers and clients are making against property. And sometimes it can be the tipping point. If one person has an offer without it versus your offer with it, it could be the difference maker for that listing agent or for the seller itself to choose your offer and get you under contract. So on our side, we offer pre-approval letters, and it's very straightforward in terms of how you get them. Essentially, you need to get in contact with me or somebody on the team. You need to tell us your plans for the project so we have a bit kind of a feel for what you hope to accomplish. And if that's something we'd be able to help with, All you need to give us is the buyer name, if it's you, if it's an LLC, whatever that title out is, the buyer's address, if that's your address, if it's maybe a PO box, etc., whatever that address might be, what your offer is going to be, and then also we'll need the property address. We'll be able to get that over to you quickly. Typically, turn times, can be anywhere from, a few minutes to a few hours. It just depends on the urgency and the need for the request. We're happy to accommodate those. But something to be advised with, these letters, we are a collateral-based lender. And so we make our loans based on the property and the underwriting of the underlying asset. So unlike a conventional or traditional lender like we've been talking about tonight, who qualifies the borrower and the borrower's income, and then gives the borrower a number they can go shop around and use for projects, we, on the other hand, evaluate the property. And we don't evaluate properties till after they're under contract. So while we're happy to give you that pre-approval letter, be advised that letter itself is not a guarantee of financing at those terms. We look at that as, again, it's our opportunity to help you get your foot in the door with the seller, let them know that you're working with someone reputable. And once you get that property under contract, you come back to us. We get that loan application in the system. We start getting those files processed. We go through that underwriting process, and we put together a structure and a loan to help you achieve and purchase that property.
Yeah, I think it's important to note that we customize those pre-approval letters to the property, and we do that for a specific reason so that we're in the know on when you're making offers. And the reason that's really important is you need to be encouraging your seller or your listing agent, right, to contact us, right? You're going to have the investment analyst name at the bottom of that and their direct email and telephone number. You need to be urging that, again, that seller, that listing agent, to call us. We can be very influential in explaining, yes, we know the borrower. Yes, we've done business with the borrower. Yes, we've looked at their down payment ability. Yes, we can close in that 21 to 30 days or whatever it is, right? And help you get that offer accepted. And then once you get it accepted, it's go time.
And I just want to just say that's 100% true, Patrick. I knew this is a client of mine that I worked with several times. They gave me a call and just said, we really want this property. You sent us a pre-approval on it. The listing agent has never worked with an investor before. They're scared, they're not sure, they're not confident in our ability to close. Can you call them? And exactly what Patrick said. I had an opportunity to talk with that listing agent, explain who we are, how we operate, vouch and validate the investor and the client that I work with. And 2 days later, they have the property under contract. We closed it several months ago. So absolutely, we're here to help. And that's what that pre-approval is to do. It helps get your foot in the door, validate the effort, and solidify the deal.
Yeah, Aaron, thanks for joining. Thanks for everybody else on the call as well. Always appreciate the time. Look forward to the opportunity to be of service.
Absolutely. And thank you, Patrick. Thank you all again for giving us your time out of this day. And we look forward to hearing from you. Please, as my number was on screen, don't hesitate to reach out. Happy to chat with you, and hope everyone has a great rest of their day.
Bye now.